Here are 3 mistakes I see over and over again regarding life insurance in retirement. My name is Daniel. I've helped hundreds of people navigate their life insurance needs. And the first is misusing permanent life insurance. Now, if you're max funding a policy, meaning you are putting the most amount of cash that the IRS will allow for a certain amount of death benefit for cash value or tax purposes, that can be fine. That's not what I'm referring to. Instead, people will oftentimes see something online or from a friend about leaving some sort of legacy or generational wealth to their heirs. If you were able to pay a small amount of premium and for that much more money was able to go tax-free to your heirs, who wouldn't want to do that? The problem is, it doesn't necessarily work like that. Let's say that you were wanting to buy $200,000 in permanent life insurance coverage. You decided that you were going to put near the minimum amount in, so you have little to no cash value. Let's say that that cash value was just $10,000. What that means is that you had a cash value of $10,000 and a death benefit much higher of $200,000. So the gap between the 200 and the 10 is $190,000 worth of life insurance. That means that the life insurance company, after doing underwriting, maybe you did some sort of medical exam, decided that it was going to be profitable for them to give you $190,000 worth of insurance. How did they come up with the fact that that would be profitable? Well, they have actuaries, they have looked at data from hundreds of years and looked at tons of people with similar health just like you and decided the statistics say this is going to be a profitable venture for us, a private life insurance company. It's not a government funded thing. Otherwise, they simply wouldn't give you the business. So if you think you are able to beat or are more accurate than all of those actuaries at the life insurance companies, knock yourself out. However, if you think they might have a small edge on you, then you are most likely to be taking a non-profitable wager with the actuaries at an insurance company. So if you're considering this, it can make sense. You just need to understand the risks involved, what you maybe need to do if the health of the insured changes drastically, etc. Number 2, paying for coverage that you don't need. Most of the time, this is going to be old policies that are still in force, you're still paying premiums on, that you probably don't need to be paying. I'll give an example. I had a couple come to me not that long ago, and the two both had old policies that were worth around $100,000. My initial reaction, given that both of these were term policies and going to expire within the next 10 or so years, was to look at the price they're paying for it currently and see if I'm able to beat it. I was actually able to find, even though they had got these policies back in 2008, I was able to beat both of them just because of actuarial tables updating, people living longer, their health had improved, etc. However, what we then pointed out as we were kind of talking through their retirement situation was that if one of the partners passed, the other one would probably need some form of coverage to be able to be okay in retirement. However, the other way around, if the other one passed, this wouldn't really affect the probability of success of retirement for the surviving spouse at all. In fact, it would make things much easier in terms of just being able to afford living because they wouldn't have to pay the expenses of both partners. So while I could have gone ahead and got them the same coverage for a longer amount of time for a cheaper price, what I was able to point out to them was you don't necessarily need this coverage. If you really want it, you can get it, but just understand the insurance company is going to approve that spouse for a certain amount of coverage, for a certain length, for a certain price. That means that their actuaries have calculated that this is most likely a profitable venture for them. Otherwise, they wouldn't make you the offer. Second example is people will also do this in terms of leaving money behind to charities or just trying to be generous. Again, you can absolutely do this. Just keep in mind, as I stated in the first point, as I stated in this one, if you are buying life insurance so that when you pass away, money goes to your heirs or a certain charity, the life insurance company believes that them offering you this coverage means it is most profitable for them. That means most likely, but not guaranteed, you might have been able to actually pass on more money if you had done something else with it as opposed to putting it in life insurance. Hey, and real quick, if you're finding this video helpful, leave a like and let me know. Back to it. Number 3, overlooking the impact on a surviving spouse. Now this one is a little bit more complicated, but let's say that there was a couple that have been running some retirement projections and they see that they are going to have a 90% probability of success just using the software that they use. Of course, that's not guaranteed if both of them live to say age 95. What they didn't account for, and what a lot don't, is that if one spouse passes away, even though the cost of living might decrease for the other spouse, they may no longer be able to support themselves as if they had both lived longer, even if neither of them are working or were never planning to work again. For example, let's say that each spouse has a Social Security benefit and they are each taking theirs. The spouse earning the higher amount of Social Security passes away, meaning that the surviving spouse starts taking the survivor benefit, which is a little bit higher than what her current amount of Social Security is, meaning she's no longer receiving her Social Security benefit, she's just receiving her spouse's. In total, they're now receiving less money from Social Security, and let's say the spouse that passed away had a pension where now the surviving spouse is only going to get 50%, sometimes even 0% of that pension. In this specific case, yes, the cost of living might have dropped for the surviving spouse, but the amount of income also drastically decreased. And if they're still paying the same amount of rent, cost of living might not have decreased by an entire 50%. Maybe it only went down by 20%, even though there was one person that you're having to support instead of two people. In this specific case, most retirement softwares are able to run, well, if this person passed away at this age, what would happen to the probability of success? Again, not guaranteed, but you can run stress tests on these areas, and that's where a lot of the times you'll find the solution. Maybe, again, not guaranteed for every single person. Hey, if we just added a 10 to 15-year term policy in this little window, if I were to pass away, the surviving spouse would still be okay. After that point, they would no longer need it. This is a tedious one, but important not to overlook. Now that you understand these 3 life insurance mistakes in retirement, watch this breakdown I did live of my own personal life insurance strategy, showing numbers, reasonings, everything, because getting this right from the beginning means not having to clean up a mess later you accidentally created today.